Let's get ready for Monday Mortgage Minute with your hosts, Tom McNamara and Bruce Woodburn.
Very impressive.
How do you like that, Bruce, huh?
Oh, fantastic. So,
All right.
Tom, thank you so much for doing this. This is amazing. It's so much fun. I'm hoping that the people that are listening to this, whether they are potential clients that are entering the market or real estate agents that we may be able to help educate, can get something out of that. And so, if you do have comments or suggestions of topics that you'd like Tom and I to hit, feel free to respond to this as well. But first of all, Tom McNamara, EXP, amazing agent, super knowledgeable, one of my all-time favorite real estate agents. If you are looking to buy or sell a house, give Tom a call. He's not only amazing, but he's got a great team of people as well. So it's an honor to be here with you.
Thanks, Bruce. Thanks, Bruce. I really appreciate you getting on, taking some time out of your day, and helping us all move forward. Right. I mean, there's lots of stuff that we do that helps people out, and you know, sharing information is really the key, right, to the whole thing. So, our first segment here today is going to be to go through a little bit about like what's going on with the market, right? Checking the pulse of the market.
Let's do it.
I think it's important to do. So, I've got a couple of charts here that show what's going on in the marketplace. Let's go ahead and get those shared.
All right. And while we're doing that, I just want to say that in this segment, we're going to talk about what's going on in the bond market. How does that affect interest rates? Where are interest rates lying right now? Tom, you wanted to cover something about an ARM versus a fixed rate and then hometown heroes. So these will all be topics that we're going to hit. So stay tuned, stay with us, and you're going to knock out each one of these for you.
Yeah, we got three great topics today, right? So,
All right. So in front of us right now, we've got a picture of the bond market. It goes back to November of 2021. These are candlesticks. So if you don't understand candlesticks, if it's red, it means it opened lower than the day before. If it's green, it means it opened higher than the day before. So you can see where it opened, where it closed, and the peaks and where it floored out. So if we go back and we look at today's market, here we are right here. So we opened up on a positive note. So things should look a little better, but we took a hit yesterday. Or excuse me, not yesterday. I think this was actually Thursday. We took a hit, and we lost about 38 basis points. So 38 basis points on the bond market costs a client 3/8 of a point on a discount point in one day. Now if you look at this, we could bounce off of this moving average right here. That's the 100-day moving average. And these create either a floor of resistance or a ceiling of resistance. We tried to pierce this 25-day moving average. It's easier to pierce a 25 than it is a 50, than it is a 100, and then a 200. And then if we look up here, there's the 200-day moving average right here. If we can pierce that, we're into some great rates. We saw back here, if we look at this date, February 3rd, we tried to pierce it. We went slightly above it, but we came back down and closed low. Look how low it dipped right here. So I'm watching the market for you, my clients, my realtors, so that you have information that will help you and your clients decide whether it's a locking bias or a floating bias. But we're expecting that interest rates are going to be, steady. We're looking at things rates right now that are running approximately 6.25%. I can't quote interest rates on the air because I'm required to give APRs and loan amounts and so forth and so on. But even Freddie Mac and Fannie Mae say the national average is about 6.6%. I'm locking loans in as low as the high fives right now. Just depends on whether the client's interested in paying some points. But those are the things that we're looking at right now. So I do expect at least two more Fed hikes this year. I think that that's going to happen, more than likely about a quarter of a point. Any questions on that?
that's a pretty technical explanation of the whole thing. But
Well, we don't want to be too esoteric because
I don't. What I want to know is, Bruce, right? You
you
just let
want my
me know
crystal
when it's a
ball.
good time to lock and when it's not a good time to lock, right?
That's all you need to know. So I
I,
do a floating and a locking bias. Now, you have to remember though, here's the thing. Interest rates come down slow, but if the market turns, man, you get a midday price increase. Like I've literally got about a minute to 2 minutes to call a client and go, "Hey John, it's time to lock. You need to do it." "Well, hold on, I need to call my wife." That's not going to work. And I don't ever want that to sound like I'm giving a client pressure to do something instantly, but I don't control the market. And those things can happen.
yeah,
And they do
gotcha.
happen.
So that's great. So I've got a little bit of data to share myself. Just looking at some market activity, things that are happening in the market. So what I'm showing here is this is the market activity for all of Stellar MLS, which covers the majority of Central Florida, excluding Brevard County and excluding some of the coast and Volusia, but all the way out to Tampa, all the way up to Ocala, all the way down to parts of Polk County. I mean, it's a big area. Um, and these charts right here, the three things that are probably the most important to look at, the number of active listings is actually much higher right now than it was over the last 5 years on average, right? Now, I say much higher, it's 10% higher, right? So
Right.
there are more active listings, quite a few more than there have been. That's good news. You have more choices as a buyer, right? It's not as good news for sellers, but it's still not horrible. New listings is way down.
Holy smokes. Is there something wrong with that needle on there? Or is it
It's
sitting at the
pegged down,
bottom?
and yeah, the reason it's so low, right, is because over the last 3 or 4 years, you either bought at a 2.5, 3% interest rate, or you refinanced into a 2.5 or 3% interest rate. And who the heck wants to sell when you've got that low of a rate, and a new rate is going to be double that, right?
Well,
So there's
it's interesting that you said that, and we can address that after you're finished with this chart.
That's awesome. And closed sales is still in the average, right? It's a little low. It's on the low end of the average, but it's still inside the average of over the last 5 years. So it's a fairly healthy market. Now, the other chart is supply and demand, right? So just looking at the number of months of inventory. So what the months of inventory means is that if new listings stopped coming on the market and sales continued at the pace that they're continuing, how long would it take us to run out of homes? It's not a perfect measurement, but it is a good measurement to look
It's a
at.
good indicator.
It absolutely is, and you can see that at one point we had less than a month, almost 2 weeks of inventory, and that was only early last year. And now we have over 2 months. Now, over 2 months of inventory is actually fairly normal. 3 months is what we consider a balanced market. 6 months is actually a seller's market, or excuse me,
Buyer's
a buyer's
market.
market. Sorry, I had that backwards. So, when we're at 2 months right now, it feels like a seller's market, or excuse me, a buyer's market, because we've been in a heavy seller's market so long,
We're in an
and buyers actually
interesting
have a
time
little
right now.
leverage.
Yeah, would you agree we're in an interesting time because we're deep into a seller's market, but buyers have a lot of control right now that they didn't have back during the COVID era from the end of 2019 all the way through to March of 2022 when it was truly a seller's market. Sellers were in control. They were getting over ask price, not making repairs, not
Yep,
negotiating. But right now, even though Tom, we're still in a seller's market, aren't you seeing a lot more activity when it comes to negotiation on your price and repairs and closing
abs-
costs?
absolutely, absolutely. We're seeing all of those things. And speaking of price, so you can see prices have peaked and have actually started to come down. Right. So we peaked in June at around 460 on our average sale, and now we're a little bit probably at about 435. It
Isn't
doesn't
that
mean the same
interesting?
house was 460 and came down to 435. It just means we're selling houses for a little less money. And so I think that's a good thing. I think there's strength in that, right? Because it's kind of like pruning your bushes, right? You prune them, they look bad for a little bit when you first prune them, but then they come back and they look healthier. And I think that's we're fixing the market a little bit.
Well, I look at that chart, Tom, and somebody may say, oh, yeah, well, housing prices are falling. Here's the thing that you have to realize. Appreciation is actually up by 8% right now. How can it be up by 8%, but houses are falling? Here's why. When you look at that chart and houses were selling at 460, that's because they were getting over what the value. They didn't appraise for then. Most houses didn't appraise during that market.
Sure.
And yet they still sold during that time because people were willing to pay it. Right now, I think that we're coming back to what the true value of a home is worth. Would you agree with that?
Yeah, yeah, and you can see that, you can see it in the chart right there. In January, it was basically 410. So from January to December, we went from 410 to 435. We're still up. It's just that we're down from June, right?
Yeah.
So it's a matter of perspective as to when when you start and stop. So let's go ahead and kind of wrap this up. But I have a question for you. It's
Yeah.
our second question here, our second topic. Somebody came up to me and asked if they should do an arm.
Yeah.
Should people be looking at arms?
Every client I look at on their own merit and their own circumstances. But here's the thing, adjustable rates become very popular when interest rates are high. You might be listening to this and go, well, they're high. They're not high. They're not even a 25-year average. 25-year average, 7.6%. We're at six and a quarter approximately right now for most folks, or in that range. So we're lower than that average. I am not opposed to an adjustable rate mortgage when interest rates are high. But I think that here's the thing, banks and mortgage companies, here's this trade secret. We love it when you do an adjustable rate. We guarantee you're coming back for a refinance. It's a guarantee. The problem is when do people refinance? When their adjustable rate is changing to whatever the market is at that point, or having its adjustment period. And then it's usually because interest rates are higher. So then you're stuck on that adjustable rate because the fixed rate went up. Look, everybody's going to refinance that's getting a mortgage right now. As soon as interest rates drop back down into 5%, five and a quarter, four and three quarter, everybody's going to refi. Get something that's safe and secure. I saw so many people get adjustable rate mortgage that knew more than I did and then got stuck with it when they couldn't get out of that program. So don't get yourself into that situation. I'm not really pushing adjustable rates in this market because I still don't think interest rates are high enough on the fixed to warrant an adjustable rate.
Good answer. All right, so hey, listen, we've got about 2 minutes left in this session. So what I wanted to do next was really really quickly cover a great program that's out there, the Hometown Heroes program.
Beautiful. Yep. So Hometown Heroes is a special program that is designed for our heroes, military, veterans, police officer, correction officer, EMTs, first responders of any type, full time employee, teachers, nurses, and healthcare workers of all sorts that are full time workers eligible to work in Florida. You can get up to $25,000 towards your down payment with this program. It They dictate the interest rates. They're slightly under prevailing interest rates that you would get on the open market. Closing costs are minimalized. Lenders can't charge any points. They can't do anything like that. So you're well protected. The dilemma, Tom, is that they're running out of money. So if you're sitting on the sidelines and you think this program is going to last forever, when the money's done, the money's done. It's gone and
Yeah.
it is getting short right now. So if you fall into one of those employment categories, you owe it to yourself, honestly, to get something going right now. Because if you wait for interest rates to drop, you're going to miss out entirely. And this program can make or break whether you get into a home right now. And honestly, even if you didn't get Hometown Heroes, let's say you buy a house for 350, that same house would rent for 22 to $2,500 a month. That means you're spending $26,000 to $27,000 a year that's doing nothing for you. Where if you bought a home and you put 3.5% down on a 350 house, your down payment's only 12,250. Your appreciation, if it goes up only 5%, is $5,200. That's a 42% return on your investment.
I really appreciate your time. Anybody wants to talk to myself or Bruce, you've got our numbers right there on the screen. And we look forward to seeing you next week. Thanks.
Thanks,
Have a
Tom. We'll
great
see you.
day.